The mainstream media is telling you the crypto market is collapsing. They want you focused on the blood in the streets, the liquidations, and the panic. But behind closed doors, a massive silent structural pivot is taking place. While retail investors are being flushed out of their positions by macroeconomic fear, the world's largest banking entities are quietly vacuuming up the underlying architecture. The rules of the global financial system are being rewritten in broad daylight. Look at the data. BlackRock, Fidelity, and Franklin Templeton aren't just launching retail exchange-traded funds, they are actively building out private ledger interfaces. They are preparing for a world where real-world assets, from massive real estate portfolios to multi-billion-dollar debt markets, are tokenized. This isn't a speculative gamble for them. It is an entirely new operational paradigm designed to capture global wealth velocity. This brings us to the core layer of the protocol. When billions in liquidity begin migrating across these institutional pipes, they require ultra-high throughput architectures that can handle atomic settlement without friction. The market focuses on daily price charts, but the real play is the integration of high-performance silicon chips with automated liquidity pools. The architecture is being built to handle volume that retail markets haven't even conceived yet. But here is the catch. This infrastructure won't just happen instantly. The shift is hitting major headwinds, from shifting regulatory compliance frameworks to intense macroeconomic resistance. The entities that survive this transition aren't the ones chasing speculative hype. They are the protocols deeply integrated with compliant, institutional architecture. The division between retail speculation and systemic finance has never been wider. This brings us to the ultimate question. Which digital assets are structurally positioned to act as the settlement layer for this new paradigm? The institutions aren't looking for memes or isolated networks. They require decentralized bridges with proven uptime, massive liquidity depths, and deterministic consensus. When the dust settles from this current market shakeout, the networks holding the actual institutional rails will command the entire space. Take a look at the infrastructure that's already live. Ripple's XRP ledger and Chainlink's cross-chain interoperability protocol aren't conceptual white papers anymore. They are working pipelines handling real volume. While retail investors are fixated on small price variations, major market makers are looking at the foundational layers capable of supporting high-frequency tokenization. The shift is moving away from speculative assets toward functional infrastructure. This brings us to the ultimate metric: utility velocity. The networks that win long-term won't be the ones with the loudest marketing campaigns on social media. They will be the ones chosen to settle cross-border central bank digital currencies and tokenized treasury bills behind the scenes. We are witnessing the separation of speculative noise from actual economic value. The future belongs to programmatic value. We aren't just talking about a digital alternative to fiat currency. We are talking about a completely automated global layer where transaction settlement happens in milliseconds, completely secured by neural and cryptographic architecture. The foundation has been laid, the money is moving, and the old guard is entirely out of time. This macro transition is precisely why smart capital is quietly allocating to ledger technologies that already have regulatory clearance and deep integration hooks. They aren't waiting for a green light from retail sentiment. The system is being completely rewired from the inside out, and the window of opportunity for early execution is closing faster than most people realize. This brings us to the ultimate execution mechanism, the Silicon Protocol itself. We aren't just observing these structural shifts from the sidelines. We are building a dedicated intelligence pipeline to trace institutional liquidity pathways in real time. If you want to navigate this transition with precision, you need to look past the superficial headlines and monitor the architectural code. The landscape is shifting, and the window for positioning is narrow. The data shows that the protocols integrating directly with institutional rails are the ones that will sustain the next major market cycle. In our next breakdown, we are going to look directly at the specific smart contract architectures that the world's largest asset managers are testing behind closed doors. Make sure you are positioned for what's coming. This brings us to a critical development: the expansion of real-world asset tokenization platforms. We aren't just looking at minor pilots anymore. Major financial hubs are actively deploying infrastructure to fractionalize sovereign debt instruments and commercial paper. The implications for market liquidity are profound, as traditional asset classes begin trading with the native efficiency of cryptographic protocols. But the true friction point isn't the technology itself. It's the lack of standardized interoperability. Right now, billions are trapped in siloed networks that cannot safely communicate with each other. The institutions don't want to choose a single winner. They want a seamless cross-chain fabric that allows liquidity to flow effortlessly between public and private chains without sacrificing security or compliance. This is exactly where cross-chain infrastructure protocols change the game. By establishing a unified messaging layer, they allow institutional data and capital to migrate seamlessly across entirely different blockchain environments. It eliminates the risk of fragmented liquidity giving sovereign entities the freedom to transact globally without compromising on compliance or visibility. This brings us to the next macro layer: liquidity optimization. When these multi-billion-dollar traditional financial pipelines begin shifting their volume onto public ledgers, they aren't going to rely on standard automated market makers. They are integrating custom institutional liquidity nodes designed to prevent front-running, minimize slippage, and maintain total transaction privacy at scale. This structural friction becomes painfully clear during periods of intense market contraction. When standard retail pools experience severe liquidity dries, the institutional systems require automated cross-market routing that can tap into deep-tier capital reserves instantly. The protocols that fail to implement these advanced compliance and liquidity nodes will simply find themselves locked out of the systemic finance loop entirely. This brings us to the operational reality: the integration of smart contract execution with real-time risk assessment parameters. We aren't looking at static smart contracts anymore. The institutions are deploying dynamic protocols that can adjust collateral ratios, verify counterparty compliance metrics, and execute cross-chain settlements simultaneously. The technical landscape is separating the experimental networks from the actual system architecture. This tech and community friction is precisely why we see networks hitting unexpected roadblocks. When security costs rise or community leadership fragments, it slows down throughput and shakes market confidence. The systems that survive won't just need strong code. They need stable ecosystems that can absorb these shocks without fracturing their user base. This brings us to the core issue: the battle over regulatory frameworks. For a network to truly scale, it cannot exist in a legal vacuum. We are watching a clear divide form between platforms that actively integrate automated compliance protocols and those that resist them. The market is shifting from a state of speculative experimentation to one of rigid institutional accountability. This pressure isn't just coming from the top down. It's a fundamental rewrite of the market's operational rules. The institutions aren't looking for loopholes. They're looking for ironclad certainty. For any digital asset or protocol trying to secure a place in the global financial framework, compliance is no longer a feature you patch in later. It is the baseline barrier to entry. This brings us to a massive structural shift: the rise of central bank digital currencies and sovereign-backed stablecoins. We aren't just talking about a theoretical upgrade to state finance. Sovereign entities are building cross-border settlement rails designed to settle transactions instantly, bypassing legacy banking networks entirely. The architecture of global capital is being rebuilt from the ground up. This macro environment leaves legacy crypto projects facing a stark choice: adapt or become irrelevant. The networks that built their reputation on complete decentralization and censorship resistance are finding themselves squeezed out of institutional pipelines. Without compliance integration, liquidity dries up, and without liquidity, token utility collapses. The winners of this paradigm shift are already apparent. We are moving toward an ecosystem dominated by highly compliant, institutionally integrated Layer 1 protocols and specialized asset tokenization networks. The projects that survive are the ones that serve as infrastructure for global finance, not those trying to subvert it. This isn't just an evolution, it's a consolidation. The future of digital assets belongs to the networks that can handle institutional throughput, meet rigid compliance mandates, and deliver real-world utility at scale. The playground of speculation is closing, and the infrastructure era has officially begun. The decisions being made by major financial hubs right now will dictate the next decade of capital flow. Position your portfolio according to the infrastructure being built, not the promises being made. Make sure to subscribe to Silicon Protocol for more deep dives into the architecture of future finance. We'll see you in the next analysis.